In this video, we're going to talk about how do we pay off your credit card without making more money. Hey, what's going on, guys? This is Sam Kwok, one of the Kwok brothers, and in this video we're going to talk about how do we pay off your credit card without making more money. Some of you guys may have 1 credit card, 2 credit card, 5 credit card, or if you're like me, I have like 20 gazillion credit cards. So we're going to talk about how do we pay them off without having to make more money. And I know some of you guys are thinking, man, I don't know if I'm going to be able to pay off my credit card with the amount of money that I'm making right now. Like, I have way more credit card debt than I can ever pay off using my income. So I'm going to show you guys a technique and a strategy that I'm actually going to be borrowing from my other video, how to pay off your mortgage in 5 to 7 years. It's a similar concept, but I'm going to modify it slightly for the credit card version. So what we start with, and traditionally what you guys are used to, is you guys are used to paying your credit card debt out of your checking account, okay? I'm gonna go ahead, there you go, checking account. And traditionally, you guys have been paying off your credit cards, right? You might be doing a minimum payment just to get by, okay? Now, I'm gonna tell you guys right now, with your minimum payment, very small chunk of that is gonna go actually towards your principal. Principal is the actual amount that you charged on the credit card, and the interest obviously is the fee that the credit card companies are charging you to be able to borrow that money. So traditionally, you guys have been doing this, right? Paying your credit card debt with your checking account, doing the minimum payment, or maybe you might be doing a little bit more just so that you can go ahead and pay it off even a little bit faster. Now, the problem with the strategy is if you leave a balance, if you're a balance carrier, meaning you just like to have a couple $1,000s sit in your credit card and just pay it off as you go, the problem with that is it's kind of like chasing your own tail. Like, it almost feels like you're never paying off your credit card. So one thing that I'm going to show you guys is the concept called average daily balance. And I'm going to show you more of the overview first, and let's go and walk backwards to talk about the details and why this strategy works. So instead of going straight to your credit card, I'm going to use red for this one. Don't do this, okay? Don't go from your checking account right to your credit cards. I'm going to introduce another tool that we're going to use for this strategy. We're going to use what's called a line of credit, a personal line of credit. So PLOC stands for personal line of credit. If you guys see my other video on how to pay off your mortgage in 5 to 7 years, we talked about a HELOC, which is a home equity line of credit. So in this particular strategy, if all we're focused on is paying off your credit cards, like you don't even have a home loan, you don't have a mortgage, you don't have an auto loan, all you're focused on is credit cards, this is a strategy. So instead of putting your money right into the credit cards, what we're gonna do is we're gonna take all of our income, all money, into your line of credit. Now, line of credit works actually very similarly to a credit card. But what's different about a line of credit is that you can pull the cash, you can pull the money out of the line of credit without being charged as cash advance. For those who don't know what a cash advance is, credit cards, certain credit cards you have the ability to go to an ATM machine, put your credit card and swipe, and you can get cash out. The problem with that is the interest rate on those things are really, really high. You might be looking at anywhere between 23 to all the way to 30% APR. So trying to get cash out of your credit card is very, very painful, right? So what we want to set up is a personal line of credit. And what you do is you take, let's say you have $10,000 balance in your credit card, okay? Some of you guys may have more, some of you guys have less. And let's say we got qualified for a $5,000 personal line of credit, okay? And what we're gonna do is we're gonna go ahead and transfer $5,000 of the credit card balance over to the line of credit. Remember, your line of credit works just like a credit card. That $5,000 limit that you have, it's not an actual, like, you don't get that up front. Okay, the $5,000 limit, you can draw this money out with the personal line of credit. You can take the money out of the line of credit, and you can pay it back on the line of credit and use it over and over again. So it is a quasi semi credit card. Again, the difference is taking the cash out of the personal line of credit is way easier than doing it with the credit card. So what we're going to do is we're going to take a $5,000 chunk out of the credit card. Now we have a balance of $5,000. and we also have a balance of 5,000 out of the $5,000 limit that we're given. So we didn't incur more debt, right? We just transferred one debt to another. Now the reason why we do this is because number one, we have that easy access that we talked about going back and forth, checking account and personal line of credit. Okay. Number two, the interest rate on the personal line of credit is significantly lower. You're looking at probably half of what your traditional credit card interest rate looks like. So with the personal line of credit, you're going to be anywhere between, I've seen as low as 7% all the way to 12%. I know certain credit cards can get that cheap, but I've rarely seen it. With credit cards, you're going to be anywhere between 13 to all the way to 26% APR. So obviously right there, right off the bat, you're going to get a savings on the interest with the personal line of credit. But that's not where we're going to save our money. Some of you guys are thinking, okay, I see where you're saving money. You're just doing a balance transfer over to a lower interest rate. That's how you're saving your money, right? Well, not quite. That's kind of half the battle. Where the secret weapon to this is we're going to talk about the concept of average daily balance and average daily interest, and how we're going to manipulate all that. So if you, once you transfer over the $5,000 into the personal line of credit, okay, now we're going to still use our credit card to do our spending. So we're going to pay our groceries, okay, we're going to do our gas, okay, food, right? And the reason why we still spend the money out of the out of the credit card to pay our food, gas, and groceries is most credit cards have what's called a grace period. Typically, on average, 21 days of grace period. So let's say you want to buy food in a restaurant, the credit cards will give you 21 days of interest free on that purchase. So that's nice, right? You don't have to pay interest within that 21 days as long as you pay it off. So what you do is, typically what we want to do, the overview of this strategy is, let's say, I'm going to do a little version of a calendar. So this is the first day of the month, and you got your 31st day of the month, right? I know February we have 28, so bear with me. But what we're going to do is we're going to do the complete balance transfer over to personal line of credit, whether you do a small chunk or another version of the strategy is you can take the entire credit card debt you have and just transfer it over to a personal line of credit as long as you have a limit to do so. So once you do that, you take all of your income and you move it over to your personal line of credit. So what you've done is you've now lowered the personal line of credit balance by the amount of income that you've generated. Make sense? Now, what you do in the between the 1st and the 31st, this is where you get to spend all your money with your credit card. Okay? Do your grocery shopping, food, you go take care of family expenses. If you have kids, diapers are expensive, so do that with your credit card. Remember, you got about 21 days of grace period that you don't have to pay interest, right? Now, at the end of 21 day or towards the end of the month, what you're going to do is you're going to take your personal line of credit, which should have been freed up by the income that you generated. Okay, you should have some room in there, right? You're going to take your credit card and pay off that, personal line of credit and pay off your credit card completely before the 21 days of grace period is over. That way you're not being charged of interest within that 21 days. Now, the reason why we do this thing, and I know some of you guys already can see why we're saving a lot of interest this way, is because we're cutting down on what's known as average daily balance. So we're going to talk about average daily balance, and I'm actually going to use black for this one. So average daily balance is how the banks charge you interest. So it's average daily interest, average daily balance. I should say average daily interest happens because of average daily balance. So average daily interest is the interest that you're getting charged for that day according to the balance of that day. So the calculation is you take your interest rate, okay, divided by 365, because there's 365 days in a year, okay, times balance of that day. What does that mean? Well, let's say today I have $1,000 balance in my line of credit, okay, and tomorrow I charge $200 into my line of credit. So my $1,000 balance is going to have a different interest next day because I've incurred additional $200 in my balance. I'm going to have a different interest, wouldn't I, right? So let's say my interest rate is 5% here divided by 365, okay? It's going to be a super small decimal number times the balance of that day, let's say 10,000. My interest is whatever that calculation is. I don't have a calculator on me right now, but whatever that day. But let's say tomorrow we take all of our income, okay, let's say $3,000 of income, and we tackle the balance on the line of credit. Now we have $7,000 of balance on our line of credit, which means if we do that same equation, okay, now we're gonna have significantly less interest that we're gonna get charged for that day. Okay, most of you guys who have credit cards, you guys are just keeping that $10,000 and waiting, and you just keep getting charged every single day on that $10,000 balance. But if you take that $3,000 income that you have, put it on the line of credit, thus reducing it down to $7,000, your interest is significantly lower, but you can access that $3,000 if you need it again. Okay, I know some of you guys are like, oh my gosh, why should we put all of our income into the line of credit? How do we spend our money, right, if we put it all in a line of credit? The idea, guys, here is that if we do this, I'm gonna go back one slide. If we do this, if we're down to 7,000 versus 10,000, and we keep the personal line of credit balance down at 7,000 all the way to the 31st, guess what? The days in between the 1st and the 31st, we've been charged with a significantly lower interest amount. All the while, we're spending all of our money on our credit cards that has 0 interest for the 21 days. Do you see why you guys are getting significantly less of interest? Because we're playing with the idea of average daily balance. Cool? And so we're taking advantage of 2 things. Credit card, being that we have 21 days of 0 interest being incurred, okay, within the purchase. The next thing is that we have our personal line of credit, which we can always take the income, put it in the personal line of credit, but it's also just as easy to take that money back out and put it in your checking account. Okay, I know there are some bills that you cannot pay with your credit cards, like a mortgage. I know you can't pay your rent out of a credit card. I know some landlords do, but it costs extra. So some of the bills that you may end up paying may not allow you to pay it out of your credit card, which I get. So this is why we want the personal line of credit, so that we can go ahead and pay, our rent. If you have a mortgage payment, you got to do that. If you try to do that with your credit card, it's not going to work. Sometimes they're going to charge you extra fees to do that. So that is basically the setup of the strategy. And let's go back to this right here. You can see why we're putting all our money into personal line of credit to lower the average daily balance and average daily interest, ADI. Okay. If you do this, guys, you will chop off the amount of payment time on that credit card by up to a third of the time. I've seen people do it within a few months. I've seen people pay off their credit cards in a third of the time as they were scheduled versus paying like a minimum payment. I've seen people pay it off in 2 months. It's gone. In fact, I have a lady. Her name's Ida. She was able to pay off I think 2 credit cards in 3 months, which is pretty incredible. And now she's working on our mortgage using this exact same strategy. So guys, if you want me to show you more of an in-depth, version of this video, I can go deeper as far as the strategy. And you know what? Even better, I'll give you guys a gift. I got you guys a gift. I'm going to give you guys a calculator, an Excel sheet calculator that you can go and plug in your numbers. So you can go and plug in your income, you can go and plug in your expenses, plug in your credit card balance, plug in how much money you can get out for personal line of credit, and the calculator will give you an estimate of how fast you can pay off your credit card, how much interest you're going to save, and what you can do with that extra savings that you're gonna get. And I'm gonna also throw in a free ebook to help you further understand this strategy. So guys, that link, I'm gonna go ahead and throw this link right here. And I'll even leave the link in the link description below, in the video description, if you're watching this on YouTube. The link is debt-free, I'm gonna see if I can have enough room, accelerator.com. So if you go to debtfreeaccelerator.com, I'm going to give you guys a free calculator and a free ebook, which is going to show you guys how this strategy works even deeper. I know some of you guys may still have questions like what if this, what if that. So that ebook is going to help you answer some questions. And also, if you guys really want to figure out if this strategy works for you, if you guys want to see the proof, then download the Excel sheet calculator, plug in your numbers, and see if it actually works for you. I'm willing to bet that it does. I've really met people that this strategy has not transformed their lives. So go to debtfreeaccelerator.com, go get the free calculator and ebook, And once you start saving your money, I want you guys to send your pictures to show me that you guys are paying off your credit cards. I want to be able to see you guys succeed. So guys, that's the strategy. Go to debtfreakseller.com and I'll see you guys there.
Hey guys, this is Daniel.
And this is Sam.
We are the Kwok Brothers. I hope you guys enjoyed that video. If you want to see more content value that we put out like this, what should they do, Sam?
Go ahead and hit the subscribe button and also hit the bell icon so you guys get notification for our upcoming videos.
That's right.